one needs to ask oneself, did the gold price fall by 7% or was it up by 100%? You'll recall that in 2023, the gold price was half of what it is today. I think that people have a myopic focus around time.
If the dollar loses 90% of its purchasing power, that means gold has to go up 10x just for that reason alone. And so that means from 4,000 to 40,000. And if the dollar loses 80% of its purchasing power, gold goes up 5x, and that puts it at 20,000. But, I think that if we have a dollar crisis, gold's not going to go up nearly that much in the rest of the world. It's going to go up a lot in America, but in other countries, not nearly as much because their currencies are going to rise a lot.
Gold sat at $20 an ounce for more than 100 years. That was the number on the board when the Federal Reserve opened its doors in 1913. Today it hovers near 4,000. Nothing dramatic happened to the metal. It didn't evolve, mutate, or gain new abilities. What changed was the dollar wrapped around it. Here's the thing. People hear the word inflation and picture some dramatic movie scene. Shelves empty. Crowds panicking. That's not how it usually plays out. Peter Schiff points to places like Argentina, Venezuela, and Zimbabwe. Gold didn't jump into the millions or billions in those currencies because it suddenly became precious in a new way. It simply revealed how broken their money had become. What this really means is that the same dynamic can unfold quietly in the United States. No explosions. No headline announcing the collapse. Just a slow, grinding loss of purchasing power. Schiff argues that if the dollar drops 90%, you don't need a crisis to push gold to 40,000. You just need math. Even an 80% decline puts gold near 20,000. The metal doesn't move. The measuring stick shrinks. And here's the twist most people miss. That kind of spike would be a US-centric phenomenon. If the dollar takes the hit, other currencies naturally rise against it. Gold would still climb globally, but the eye-popping numbers would show up mostly on American screens. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
Gold was $20 an ounce, for 130 or 140 years. And it was $20 an ounce when we created the Federal Reserve. So now it's gone from $20 an ounce to 4,000. I mean, people probably would have thought, oh my God, back then, what would the world be like if gold was $4,000 an ounce when it was just 20? So, inflation is going to be bad. Yeah, I mean, but whether it becomes some kind of apocalyptic Mad Max type in situation, I mean, there are a lot of countries that have gone through massive inflation, Argentina, Venezuela, Zimbabwe, and those are like hype, so what's, gold there went to millions or billions or trillions, whatever it went to, right? But look, I don't think gold's going up to that price because of some kind of, military, crisis. It's just going to be the dollar and inflation. And, if the dollar loses 90% of its purchasing power, that means gold has to go up 10x just for that reason alone. And so that means from 4,000 to 40,000. And if the dollar loses 80% of its purchasing power, gold goes up 5x, and that puts it at 20,000. But, I think that if we have a dollar crisis, gold's not going to go up nearly that much in the rest of the world. It's going to go up a lot in America, but in other countries, not nearly as much because their currencies are going to rise a lot against the dollar. That means the gold price won't go up as much there as it will here. But a lot of it depends on how the government reacts to this crisis. If we go all in on socialism, if we elect a outright, Marxist type socialist president and Congress, and all of this gets blamed on capitalism, yeah, it's not going to be a good world here in America. But it's not going to be because gold went. It's not going to be because of what gold did. It's going to be what we did as a consequence of it.
Yeah, I think it's a real possibility if they don't fix it. Yeah.
Rather than learning our lesson and atoning for these mistakes and correcting them and cutting government spending and deregulating and doing all the things that we should have done, but we never did because there was too much short-term pain. Once the short-term pain is so excruciating that all right, now we might as well solve the problem because there's no point in trying to avoid the pain. We got it. We got it in spades. It's surprising that silver is still this cheap. Especially given that gold is 4,000. So, that's why I've been pushing silver. I've been telling people, my company Schiff Gold, buy silver. I know the name is Schiff Gold, but buy more silver than gold. I've been saying that now for the past year, that people should be, really looking at silver because it didn't make any sense that it was so cheap. If China knows that we want it, they don't want to supply it. I mean, we've basically declared war on China. I mean, not a hot war, but as a form of Cold War, trade war. We've claimed that they're our enemy, that they're ripping us off. And that's a dangerous thing to do. They've been supplying us with goods and loaning us the money to buy it. They're our biggest supplier and our biggest banker, and we're telling them that they're screwing us over and that they're our enemies. Not a very good strategy.
Gold has been on a tear, moving faster than most people expected. Rick Rule emphasizes that a 7% pullback isn't a warning, it's a natural pause. The real headline is that gold doubled in a remarkably short span, and the market often forgets just how fast that climb happened. Panic over a small retracement usually says more about investor expectations than the metal itself. Over the next decade, gold is expected to perform well, but it won't rise in a straight line. 2 or 3 corrections of 25% or more are entirely normal in a long-term uptrend. They're part of the rhythm, not a sign of failure. Rates are the next layer of complexity. A Fed cut might look like a boon for gold in the short term, but it carries broader consequences. Rule points out that lowering rates signals the political system is less focused on defending the dollar. Economically, the U.S. doesn't truly need cheaper borrowing costs. Controlling inflation would serve the country far better. Yet the weight of massive national debt constrains the Fed, nudging it toward choices that could weaken the currency over time. For gold investors, the takeaway is clear: volatility is expected, retracements are normal, and underlying fundamentals remain supportive of long-term growth. Let's get back to the interview.
I think the gold price over the course of a decade will do well, but gold went too far too fast. I also think that people's reaction to the decline was naive. One needs to ask oneself, did the gold price fall by 7%, or was it up by 100%? You'll recall that in 2023, the gold price was half of what it is today. I think that people have a myopic focus around time. In my experience, Kai, people who have problem with a 7% decline should find a different sector. No. I think that they have a decade of good markets in front of them. But I suspect that 2 or 3 times in the course of the next decade, that the gold price will fall by 25% or more without derailing the gold bull market. In that case, there's nothing wrong with gold. There's something wrong with the investor. A rate cut will be catastrophic for America, wonderful for gold. A rate cut will signal, if it occurs, that U.S. society politically has lost any interest in defending the integrity of the U.S. dollar. I mean, we could talk about real interest rates, but that would be a long discussion. Suffice it to say that the U.S. economy doesn't need a rate cut, although the U.S. Fed may as a consequence of servicing the U.S. debt. But one of the things that has kept the U.S. dollar relatively strong compared to other fiat currencies has been that the nominal interest rate in the U.S. is higher relative to U.S. inflation than nominal interest rates are in other countries relative to their nominal inflation. A real policy of rate cutting by the Fed would signal to the world, as I say, that U.S. society doesn't care any longer about defending the integrity of the U.S. dollar. From a historical perspective, we saw this in 1975. At the beginning of that period, the U.S. tightened the interest rate, concerned about inflation. The gold price tanked, it fell by 50%. When the U.S. Fed lost its nerve at the end of 1975, the gold price went on a tear, an absolute tear. And I mean, as a gold holder, that's not unwelcome. But for the rest of one's life, that's a bad thing. The Fed is alleged to be independent, except that the executive appoints the head of the Fed. I am, as you know, Kai, I've just started a bank, and I have a lot of experience with the lower levels of the Fed. And the lower levels of the Fed, the employees that I've dealt with, believe that the Fed is the only agency of the U.S. government that is concerned with defending the integrity of the U.S. dollar. They believe that they're alone against Congress and the executive. The top of the Fed, who I don't know, I know a couple of ex-governors, but I don't know the current people, seem to be much more political. I think I never exhibited FOMO.
Okay.
When I was younger, one mistake I made is because I was a successful investor in resources, I thought I was a good businessman and I could invest successfully in sectors I didn't understand as well. I proved to myself that that wasn't the case, sadly. I've since become a good investor in conventional financial services, not fintech, but things like banks, insurance companies, because I've operated those businesses for 50 years. I was never particularly a greedy, fear of missing out style of investor. There are two types of errors in financial markets. Well, there are many types of errors, but going to FOMO, there's errors of omission and errors of commission. Errors of omission is where you miss making money. Errors of commission is where you lose money. And errors of commission are much more serious than errors of omission. If you miss Bitcoin and you only make 300% in a gold bull market, is your life worse? I think not.
Even without a dramatic financial headline, a shrinking dollar can push gold to levels that seem extraordinary on screen. Temporary pullbacks, like the recent 7% dip, aren't warnings. They're natural pauses in a rapid climb. Over the next decade, the trajectory is unlikely to be linear. Corrections of 20 to 25% or more are baked into the rhythm. The broader implication is that currency strength, debt loads, and central bank choices matter far more than short-term charts. As rates, policy, and debt pressures interact, gold's long-term path remains robust, resilient, and largely dictated by fundamentals rather than sentiment. If the US dollar continues its gradual erosion, how might gold's value recalibrate the global perception of wealth and influence financial behavior domestically? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.